Why would you sell a great property in 3 years if you could hold it for a long time and make great cash flow and it appreciates? Where are you going to get something better than the thing you worked so hard to get?
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
Hey everyone, welcome to today's show on Wealth Strategy Secrets. Today we're joined by Joel Friedland. Joel is an accomplished real estate professional who provides clients with comprehensive solutions for acquiring, selling, leasing, and investment. Joel manages a portfolio of properties on behalf of investors, which include individual investors, trusts, and families. Joel obtained his extensive experience as co-founder of Epic Savage Realty Partners and completed hundreds of transactions while being responsible for leadership development at the firm for over 20 years. After Joel and his 10 partners sold Epic Savage to an international real estate firm, he founded Brit Properties and Brit Asset Management, where he oversees leasing, sales, and asset management for numerous property investments. Joel has been a member of the Society of Industrial Realtors since 1990 and the Association of Industrial Real Estate. Having served on the board of directors and moderating panel discussions of industrial real estate topics, Joel attended San Diego State University, where he was a member of the ATO fraternity and is a graduate of the University of Michigan in Ann Arbor. Joel, welcome to the show. Thanks, Dave. It's great to see you. Yeah, no, great to connect as well. Quite a background you've had, and I know you've been in the market for many different years and have been through many different cycles, which, should be an interesting topic, that we can kind of get in today. But as we get started, maybe to help the listeners learn a little bit more about you, why don't you tell us a little bit more about your background and how you got into the space?
Sure. First of all, I'm glad we're doing this because we've been watching each other on podcasts. We're finally meeting in person. This is great. My background started in real estate when I was 22. I went to work right out of the University of Michigan for a family, not my family, but a family. Their name was Podolsky, and they were one of the bigger owners of industrial real estate in the Chicago market. They owned 84 industrial buildings, and I was looking for a job in real estate, and I cold called Mr. Podolsky. And I said, I'm looking for a job in real estate. And he said, come in today for an interview. So I went there that day, and he said, my 84 building portfolio is 6 million square feet. I've been very successful for a lot of years. But in 1981, which was my first year, interest rates were 17%. Companies were scared to death that they were going to go out of business. And the last thing they wanted to do was move from an industrial building that they were in to a different industrial building, because the moving cost and the disruption could put them out of business at a difficult time in the economy. So Milt said in the interview, he asked me, what would you do to fill up my 10 vacant buildings? And I said, I would cold call in the industrial parks. I'd go door to door in person. It was summer, so the weather in Chicago is better in the summer, obviously. And I said, I'm just going to go out to the industrial parks and I'll find tenants in other buildings, and I'll convince them to look at your vacancies, and I'll try to put deals together. And he asked, what qualifies you to do that? And how do you know that that's a good idea? I said, well, when I was 14, I went door to door in my neighborhood in Highland Park where I lived, and I convinced 70 people to let me landscape their properties for the summer. I said, I'm a really good cold caller. I said, my hit ratio when I'd go door to door, I'd meet with a husband and wife and sit with them for 20 minutes. And my hit ratio was every bit of 70% yes. Probably because I was doing it for such a low cost. I was 14, so I wasn't charging enough. So they said, oh, let's give this kid an opportunity. So it was similar because going and getting a new tenant at a tough time, the way to do it is to say, I'll give you better rent. I'll reduce your rent because times are tough. And I filled up that first year all but one of the 10 buildings. There was still one left. But I really went crazy. I cold called thousands of companies all over the Chicago area. And I worked for the family. My mentor was Milt's son and another guy named Richard, who took me under their wing. That, to me, that's the secret of all success. Having a great mentor or having multiple great mentors. And I had that. And I was so lucky to have these incredibly brilliant, experienced people who were major players in our market.
Yeah, that's really awesome. I think a lot of people just, don't really think about that in terms of mentors. And it seems to be more prevalent in certain industries versus others, so I think there's a lot of folks in real estate and, as my kids are, starting their careers and everything, I've been advocating that for them as well to really just kind of latch on, right? Because it's creating those, relationships that can really, up level your game and getting the hands-on experience that you're just not going to get from any type of schooling, which is interesting. So Joel, tell me a little bit about, obviously, you got into the real estate space at a very early age. It can be a very lucrative industry for those who excel in their specific spaces. So did you start to create a, particular wealth strategy for yourself? Once you start to create, your vision and realize, wow, I can really scale this. And what did that really look like for you?
Well, let me give you the summary. First of all, yes. When I was working for Milt Podolsky, I looked at him and I said, one day, I said, Milt, I'd like to learn to do what you do, which is being a syndicator. At the time, I was an industrial real estate broker. So I was an agent for Milt and for other people to do leasing and sales of industrial properties, which are manufacturing buildings and distribution buildings. We can talk about industrial. It's a very different niche than most people know about. But I learned it over this period of time that I worked for the Podolskys as my mentors. And I said to Milt, I don't think you made all your money being an agent. He laughed and he said, I did not. I said, well, I'd like to be like you. Whatever you did is what I want to do. So he said, I'd be happy to help you learn how to build a portfolio like mine, starting with the first property. I'll be your first investor if you put together a syndication. So I said, that's a great offer. So I went and found a property and I said, this will be my first of many. And I put together a group. It was a $560,000 deal in a place called Gurnee, Illinois. We did a 14,000 square foot industrial building, 2 loading docks, 18-foot clear ceilings, a little office in the front, a drive-in door so they could drive vans inside. And we bought it and we leased it and we had a tenant. And I brought in a bunch of investors for $20,000 each. And they said to me, how much are you putting in? Because we're not going in unless you do. So I put $20,000 in as well. And it worked. And I went and did more. And Milt invested it again. And his son, Stephen, my mentor to this day, who's still my partner and my close friend, went into the deal with us. And I kept expanding the network of investors through people that I knew by being an agent. I dealt with a lot of companies, and owners of companies have money. So I convinced many of them to invest with me. And over the years, we bought about 100 properties up until today, all really similar, industrial buildings, single tenant primarily, net leased. And my 200 investors, I know every single one of them. And when I do a new deal, when we buy a property, I go to the same group. And not everybody invests in every deal. So it's good to have a big group, because maybe 30 or 40 will be in a position or be interested in investing in one of our new deals. But I built up a portfolio, and we self-manage. We do a lot of the leasing with a brokerage company that we're close with. And it's been great. But I had a disaster in 2008. Everything was going great. I thought I was like the biggest hot shot. It's like I was a country club guy. I had a fancy car. I had a big house, and I thought this is going to go on forever. And then we got slammed with the Great Recession. I had 7 banks. I had borrowed money from people, promissory notes. I had 63 people I had borrowed from. I owed $70 million.
Wow, that's a big number. Yeah,
it's a big number. And boy, if 1981 was tough, Milt had 10 vacancies. 2008 was 10 times worse, if you ask anybody out there, because the banks weren't lending. You couldn't refinance. Tenants were going out of business. Tenants were coming back and asking for reduced rents. So I don't know if you've heard of a forbearance agreement, but I had 7 banks and I had forbearance agreements at most of them, that means let's let these people try to pay off the loan over a longer period of time with lower payments so that we don't have to foreclose. It was really miserable. And I always point to my couch in the back. That's the couch I was lying on when I was depressed and thought I had lost 200 people's money. My investors, I thought, were going to just be disappointed, and I was just ashamed of myself. What had I done? How could I be in a position when I was doing so well that all of a sudden, bam, it stops, and it looks like I'm going to lose everything? So I literally couldn't get off the couch. I have to tell you that I did think about taking my life and being done. I was so ashamed and embarrassed.
Wow.
It was hell. And with a lot of help from family and friends and some therapists and a little medication, I got off the couch and I went to work and I saved the portfolio. Not everything worked. There were still some deals that never came back, but a bunch of the deals came back. And I started rebuilding. My net worth went from millions of dollars to negative millions of dollars. And I had to work just to get back to zero. I had to borrow. This is one of your things. I had to borrow from my Northwestern Mutual Life Insurance whole life policy. I was lucky. I had $200,000 at that point of cash value, and I borrowed it all. And we lived on that until we came back from the depths of despair. And after that, I changed the way I do things. And some people think that it's crazy that I buy properties now all cash, no mortgage. I know you like leverage. I know a lot of real estate people like leverage. But for me and for my mental health, I can't tolerate losses, and I can't tolerate the feeling of shame and embarrassment. And I'm vulnerable enough to admit that I know who I am. So now when I put deals together, we buy them all cash, no mortgage, with no intention to ever put a mortgage on. And the wealthiest people I know like it. Who knew? I had no idea that it would work. About, 5 years ago, maybe, I went to my accountant and I said, I want to do deals all cash. And he said, you'll never get investors. I said, well, then I'll never get investors. And interestingly, there's a group of people who are extremely wealthy who want to preserve their wealth as opposed to trying to make a big return on money because they need to do it to build up wealth. They've already got it, and they want to make sure they don't lose it.
Wow, such a powerful story, Joel. I can't imagine what was going on in your mind. And it's so interesting how people really at the top of their game, whether that's, sports or entertainment, or business, right, have some type of, massive event like that, that really changes the trajectory of, how you think, how you go forward. And, thankfully, you had enough support and were able to kind of get through that and move on to the next level. But what would you say in terms of, what do you think was the most important learning lesson kind of coming from that experience?
Well, I think it's that mental health is everything, and how we make decisions is is more important than anything. And I believe that most people, if they're honest, make a lot of their decisions based on hunches and on their mood. And that's not good. You need to make it on due diligence and math. And so I had three partners when I built up this very large portfolio of dozens of buildings. And I trusted them, and they trusted me. And some of the buildings that were bought were buildings I never even saw. And I just trusted that my partners knew what they were doing. They might have, but maybe they didn't. Maybe they needed some more experience, and maybe they needed to be more conservative. So I now get involved in just even the most minute details of every deal, because if you let mood drive your decision to buy a property, it's a terrible strategy. It has to be the math, and it has to be thinking through what you're looking at down the road 10 years and where you want to be, as opposed to let's do the deal real quick and make a lot of money and go to the next thing. So we buy long-term hold properties where it takes an awful lot to find them. I go door to door still, and I have a son in the business and a partner in the business. We still cold call to find deals. If we find a great deal, why would we want to sell it in 3 years? You know, all these people who put together these offerings, and they say it's a 3-year hold. They must not be very happy with the properties if it's 3 years, because why would you sell a great property in 3 years if you could hold it for a long time and make great cash flow and it appreciates? Where are you going to get something better than the thing you worked so hard to get? And so that's my philosophy: is buy for the long term, have great staying power, pay attention to the details. And in terms of mental health, don't ever make a decision when you're elevated and you're in a good mood, and don't ever make a decision when you're struggling and in a tough place, because there's nothing better than knowing that you've thought something through and gotten great advice. So I have a group of advisors. I have 8 investors that I run everything by before we buy a property. I never did that before 2008. I went to my 3 partners and said, hey, this looks great. Let's buy this one. Sometimes we got lucky. I mean, there are deals where we made a lot, and then because of 2008, we saw where the holes were. So I think that's the answer. Really, really pay attention. And it's our micro focus also. We only own properties, industrial properties, in the Chicago area. We don't want to go to some other town where someone's going to eat our lunch because they know the market and we don't. So that's a big part of it too, is just really being focused on one thing and doing it well. If I can't do something really well after 43 years of doing it hundreds and hundreds of times, there's a problem. And now it just comes down to how do we make the best decisions to protect our investors and ourselves.
Yeah, really sage advice, Joel. We were just talking about that in our mastermind group the other day, and it's that emotional factor that really gets the majority of investors, regardless of the asset class, right? And, you could be on a high, like you said, and be, bullish about a particular opportunity, but you haven't, done enough due diligence, don't really understand it enough, and kind of be caught, there. Or, on the low side, right? I mean, right now, fear sells. And people are trying to, put you into, certain assets based upon fear, right? Based upon kind of what's going on. And this is kind of why, we like to advocate creating a proactive strategy around your wealth, so that if you know clearly where you're going in the future in 10 years and 25 years, you can align to that. And, we've definitely seen more success like that. And you've seen obviously key investors like Buffett, right, who have just very, key strategies lined up. So such an important part of, being a professional investor is, right, having a strong strategy in place. So let's unpack the industrial space a bit more, right? We've had a lot of guests on the show that we've talked about multifamily opportunities, self-storage, land. I mean, all these different, types. But I think a lot of people might be new to the industrial space. So if you could kind of unpack that and just kind of, start as if we were at a 101 and just talk about some of the, main elements of industrial.
Sure. So industrial is property that's generally right on the highway or right on the tollway, or it's hidden away behind other things. It's hidden behind multifamily. It's hidden behind retail, because industrial is manufacturing and distribution. And these are buildings that the consumers don't need to show up at, because they sell through business to business as opposed to business to consumer, except for e-commerce, which is a huge part of industrial. So if you drive down the highway and you see a giant Amazon building, and it's got a bunch of truck docks and a big area where trucks are parked, and it's got big high ceilings, and there are these huge buildings, that's industrial. And we call that industrial. These are large, modern buildings with high ceilings and very sophisticated deluge sprinkler systems in case there's a fire. They're actually very attractive. They're usually made out of tilt-up or out of what's called precast concrete. And that's industrial. We own some of that, but that's mostly owned by institutional owners like pension funds and insurance companies and Blackstone and BlackRock and so forth. They're huge, they're expensive. A level below that is what's called B and C industrial. And those are older buildings, smaller buildings, lower ceilings. And those are properties that don't cost as much and are not favorites of institutions. They're favorites of ours. So in the Chicago area, there's 1.3 billion square feet of industrial, and most of it's B and C. And what I love about industrial is every building has a different kind of tenant that's in a different business. They're all fascinating. In our case, we have a tenant that was on Shark Tank in year one who makes protein bars. He makes $18 million a year of protein bars. So the building that he's in, he's got 50,000 square feet. He's got 80 employees. He built it up from nothing. When he was on Shark Tank in season one, he was doing $50,000 in volume, and he was doing it out of this little bakery. So now he's got this big business, and you walk in there, it's so impressive. Everybody's wearing their white suits and their little hairnets so that the hair doesn't fall into the protein bars. And there are machines and there's rooms. And this is a typical tenant of ours. And he pays net rent. His net rent is $8 per square foot. So that's $400,000 a year. Now, for us, we buy buildings all cash, no debt, and our investors insist on an 8% return. So in a building like that where the rent is $400,000, that means that we can afford to be in for $5 million. That would be the value of the building, because $400,000 is 8% of the $5 million. And then every year the rent goes up a little bit. We call those annual escalations. So our investors invest with us for cash flow and appreciation, but they're these smaller buildings, and many of them are made out of brick. Some of them are metal. We've got so many fascinating tenants. One makes exhibits for children's museums. We have distributors. You've eaten yogurt out of the yogurt cup, the little white cups that they come in. Those are made somewhere. That's one of our tenants. So we got a guy who makes safety products for the welding industry. You know, if you're a welder and you're wearing the protection and you're wearing something so sparks don't get you. He makes the suits so the sparks don't catch you on fire, and he makes the screens because if you look at the flame when someone's welding, it hurts the retina in your eye. So he makes these screens so that when people walk by, you can see through the screen. They're different colors, but they're somewhat clear, so you can see, but it protects your eyes. He makes those screens. I mean, we've got these amazing tenants, and they pay rent, and they've got good credit. We rarely have a tenant that we have to kick out of a building, because usually they're divisions of much larger companies, or they're family-owned businesses that have been around for decades. And they're sticky. Our tenants are sticky. Manufacturers don't like to move because they can't afford to lose their employees. They can't afford to move their machines. They can't afford the downtime. So I'd say the average tenant stays in our buildings for 15 years and longer. And every year the rent goes up, except in 2008. Again, that was hell. Rents did not go up. Yeah. So you can't count on rents to always go up. But those are our kind of buildings. And it's so interesting because it's the people more than it's the companies. Almost every one of these companies is owned by a family, or it's owned by a person who's got partners, but the family's still involved because it's all part of their estate. So I get to know the individual tenants, and I get to know people who are in their family or who are their partners. And those are, interestingly, the people who become my investors. The Shark Tank guy is an investor with $1 million in another deal. We just made a lease with somebody. They got to know us. They trust us. And the CEO of the company just invested in one of our deals. So we're creating this synergy between our tenants and our investors. A lot of the same people are both. And I just love the business. It's every day is a new adventure and learning something.
Yeah, really interesting. Tell me about tax advantages. Are you doing cost segregation studies, and what does the depreciation typically look like?
Yeah, in a cost segregation study, there's virtually no tax on your income for the first 2 years. So the 8% is tax-free. Now in the third year, you don't have that the jump. It starts coming down to a normal level.
Yeah.
But we do take advantage of every tax law we can on behalf of our investors. The normal building without a segregation study, about half of the cash flow is sheltered, so there are losses. Milt Podolsky told me when I asked him to help me invest the first time I asked him to do that, he said, "Yeah, I'm making about $4 million a year on my cash flow, and I pay zero in taxes." And I said, "How do you do that?"
Exactly.
You'll learn. You'll learn.
Yeah.
So I've learned.
That's part of the wealth strategy for sure. What about risks, Joel? Especially 2023 we're in right now. Lots of different things. Obviously, you don't have any interest rate risk, but tell us about what are some of the key risks in this industry?
So there are two kinds of industrial properties. There's the ABC; those are the property types. But there's two kinds of properties. One is multi-tenant, which is more similar to multifamily, and one is single tenant. A multi-tenant building, usually in our business, has 3 units, 5 units, and it's not like where there's 100 tenants in a building. That's not really industrial. And then there's single tenant. A lot of companies want their own building. They don't want to share a common wall with anybody. They make noise. They make some kind of smell. They just don't want to share. So these freestanding buildings that we own, the risk is vacancy, because if it goes vacant, it's 100% vacant. And even if there's not a mortgage, there's still taxes, insurance, maintenance, and utilities. So when it's vacant, we have to pay those. And when it's vacant, there's no money coming in. So I say there's really 3 risks in industrial: vacancy, vacancy, and vacancy. And it happens. There are times when we have vacant buildings and we have to get through a period while we're marketing them to find a new tenant.
You guys are vertically integrated though, so I'm assuming you're doing, all the leasing and everything is run internally then?
Well, we do the property management, which by the way is a loser property management generally is a loser business.
Yeah.
The cost of managing is very high because if you do it right, it's a daily thing. It's a lot of accounting, but it's also a lot of problems with a roof, problems with the HVAC, problems with the parking lot. And the management, to run our management company, each individual manager makes close to $100,000. And to get a good one, that's what you have to pay. We've had subpar people, but then our properties don't get managed well. And we have all the other overhead. And when you add up how much we pay people to manage properties, because they have to be sophisticated as property managers of industrial, they have to understand all the physical systems. And it's very expensive. I would say the funniest thing is when an investor said to me, "You charge 4% management, you're making a fortune." I said, "You take the management company, you manage it, and you cover the loss." He said, No, you do it." So yes, we do self-manage, and it's a lot of work. It's my least favorite part of the business. My son came into the business about a year and a half ago, and I put him in management. And after a week, he said, "I can't do this. This sucks." So he went into brokerage or into finding deals and putting deals together.
What do you think about where we are in the cycle for industrial specifically right now?
The market is as good as it's ever been. Values are higher than they've ever been. We have a building that we paid $6 million for about 15 years ago, and today it's worth triple. Depends on where the buildings are. We do infill, which is near the city and near the airport, and that's where they go up in value the most when there's an increase in asset values. I think it's going to blow up. I think it's going to be a disaster, which means I think there will be vacant buildings. It's all about supply and demand, and they're building too many new buildings, and I don't think there's enough tenants in the market to fill them all up. So I'm expecting a downturn, which is one of the reasons I'm so comfortable with no debt. Because if there's a downturn, we don't lose our equity. We just have to get through it.
Right. You've got that flexibility, which a lot of people are going to get, caught out, right? If they financed 3 years ago and weren't anticipating this.
Yeah, it's the opposite of what's happening with office buildings. As office buildings are being given back to lenders and refinancing becomes a problem for the owners, I feel like they're going through right now what I went through in 2008. It's just a terrible time for them. And it's a terrible time for a lot of the malls too. But industrial is picking up a lot. When retail goes bad, industrial goes well, because Target online and Amazon and Wayfair and everybody else who's got products in a warehouse, online sales are booming, and that means they need warehouse space. And because there's a huge problem politically with China, a lot of companies that used to make their products in China are bringing them back. It's called reshoring or onshoring. So manufacturers are coming back, and that's filling up industrial. So industrial has been booming, and there's been no let up. It has not gone down at all. But I think the interest rates are starting to affect it.
Yeah. Interesting. Joel, if you could give just one piece of advice to our listeners about how they could accelerate their wealth trajectories, what would it be?
Find a person who is the avatar for what you want to be and where you want to see yourself, let's say in 5 years, and convince them to teach you what they know, like Milt Podolsky taught me. If you work with somebody who has all the knowledge and all the judgment that made them as wealthy as they are today, and you can convince them that you're worth their time to train so that you can help them do what they're doing, but they can help you become successful like they are now. To me, that's the answer. Everyone I know that has literally millions and millions of dollars started that way. People didn't start fiddle farting around trying to figure it out on their own. Those people just I call that wide but not deep,
Yeah.
and they struggle.
Yeah, excellent. No, I think that's such a great piece of advice. And also, in all aspects of your life, right? What you're trying to get better in, you can have a mentor in, whether it's your health or, sports or something like that, right? We always want to be, if you're trying to up level your game, right, you have to make an effort to do that, and you need some type of mentor to get there. So it's not only in business, and that's why we view this whole thing holistically, because back to your point about mental health earlier, those things are really key. How you think, how you can work through challenges, right? Because we're always going to have challenges in life, right? I mean, there's so many things going on this year, but I mean, think about it. When haven't there been so many things going on geopolitically, environmentally, all of these different factors. But what you can control in life is, how you actually, meet those challenges, right? And do you have the leadership and the perseverance to really get through it? So having a mentor is key to be able to grow that.
Yeah, your holistic approach, I think, is really right on target. And the things you talk about are really important. I think this mental health thing is a huge component, and that means you have to be physically healthy, and that means you have to have good relationships, and that means you have to have goals. And so what you talk about and the things that I've heard you say and understand that you help people with, I don't think there's anything that's more important than what you're talking about.
Yeah. Yeah, appreciate that, Joel. Really, it's been such a great conversation, enlightening us about your journey. I think has just been super insightful, Joel, and I appreciate the transparency. You sharing that with the audience. There's so much to learn in those lessons that you've shared, and as well as all your expertise around the industrial space. I think it's a super interesting asset class, and one definitely worthy of looking at. If people would like to connect with you, learn more about you, what's the best place they can reach out?
Sure. Our website is Brit Properties, BRIT 1T Properties.com. And on our website, it talks about our risk-averse philosophy and how people can invest starting with $25,000. Most people don't, but some do. We have a few case studies in there. We have one very interesting thing. We have an article that's called "Why You Should Not Invest with Us," and it tells all the reasons why people should be careful and what questions they should ask.
Love it. Joel, thanks again for coming on the show. Really appreciate your time.
Dave, thank you.